down here, let's talk about, well, frankly, what else can I do with accounts receivable? See, we've talked about I can create it, I can collect it, I could write it off. What else can I do with it? Well, it is an asset after all, so there's a number of things I could do with it. One is I can pledge it. Now, it does not mean that the receivable sticks its right hand in the air and takes an oath. No, all we're going to do here is go to the bank or some other lender and say, you know what, can we get a loan? And the bank says, possibly. What are you going to offer as collateral to protect our interest in getting paid or paid back? And so we say, well, we're going to use our accounts receivable, our existing AR, we're going to use as collateral for the loan. In that case, the company holds on to the receivables. They retain the title, but they have pledged that the proceeds as those receivables are collected will be used to pay down the loan. Now, does this result in any kind of an accounting journal entry? No. It's simply a footnote disclosure. It's very useful for the reader to understand, oh, I see you have this current asset called receivables. However, it's already tied to a liability on your balance sheet as well. So that's one option. That doesn't do a whole lot other than facilitate us getting a loan. What else could we do with it? We could sell it. It is an asset after all, but we don't call it selling. I think someone in the great accounting universe said, no, if we're selling receivables, it needs to have its own special name. We're going to call it factoring, and we're going to call the buyer of that receivable the factor. Okay, so yeah, the terminology is a little bit strange. Know that it's just a sale, or at least that's the idea. Okay, another way to think about it is we're converting. So we're going to say, you know what, I don't want to deal with this. And that's usually kind of behind the scenes is, my company, we're good at selling, and we're not bad at collecting, but you know what, we always have some bad debts, we always have some delinquent customers, and it is a giant pain to try to get them to pay, and frankly, we're not very good at it. So we'd rather, instead of having this receivable sit on our books and maybe ultimately write it off as a bad debt, we'd rather just go ahead and sell it now. So it's converting the receivable into cash by assigning them to a factor. But there's a kicker. We can do this either with or without recourse. Don't worry, we'll talk about what that means in a moment. Now, one other interesting question. Does the customer have to know? No. Now, you can notify them and say, hey, you don't pay us, you pay this factor over here. Or not. Maybe you say, yeah, the factor says, no, that's fine. They'll just mail it to the same mailing address you gave them, and then you just forward the payment on to us. It could be either way. It's up to you and kind of the arrangement to decide if that needs to happen. All right, so this next one is now dealing with factoring without recourse. Okay, so I mentioned that there's two ways to do this. I can do it with recourse, but let's start with without recourse. And what I would say is without recourse is a true sale. It basically says once we're done, we're done. You factor, you have no recourse against me if I sold you a lemon. So if the receivables aren't what now that's different than me misrepresenting them, I suppose. But basically we're saying, no, you know what? The risk is going to you. And that's the big thing. Without recourse means the factor, the buyer here, is going to assume any further risk of loss on collections. Because this is a true sale, the account receivable is going to come off the books. But let's actually look at what a typical factoring journal entry without recourse would look like. Okay, so let's start here. We'll start with the credit. That's, I think, the easiest is, well, what receivables did you sell? We got to take those off the books. So that's going to be a credit. We got to get that AR off. Now, the factor is going to pay us money. So there's going to be cash. That's going to be a debit. But then we get to a couple of unique things. The first is the factor may say, well, wait a minute, though. Look, we understand accepting the risk of loss. But what if one of these customers actually returns their goods? Then they don't have to pay, but that really wasn't a receivable, at least not legitimately, and you shouldn't have sold it to us. So even without recourse, we may have certain items like that. And so the factor says, what I'm going to do is I'm going to pay you X, but I'm not going to give you all of it up front. I'm going to keep some. And we call that a due from. So we put down due from factor. Think of it almost like a security deposit, kind of. because we're saying, okay, factor, you get to hold on to a piece of my money, and ultimately either A, nothing goes kind of sideways and you collect those receivables, in which case you'll pay me the remaining amount, or if something goes wrong, kind of like damaging an apartment you rented, they'll keep it. That may not balance. Why? Well, if you say, look, my interest is getting cash now, I don't want to deal with this, do you think you're going to get the full amount? Probably not. See, the factor has to look at this and go, wait a minute, I'm taking all the risk. I think you should have to pay me for that. And so there's typically going to be a loss. So that's the missing debit here. The sale is going to mean we're not going to be able to get dollar for dollar. We may be able to sell the receivables for 80 cents on the dollar or 70 cents on the dollar, or whatever the case may be. But again, that due from is simply if there's a need to protect the factor from returns or unrecognized discounts or customer disputes or anything like that. That's all that represents. But you can also look at it as the cash plus that due from is really the price tag of those receivables. So that's without recourse. What if it's with recourse? Well, that depends. With recourse in general is where you say, okay, I'm selling you those receivables, and the factor goes, oh, not so fast. Nope, we're not done here. In this case, the factor is provided with an option. And we say, okay, factor, look, after certain conditions are met, you can force us to buy back anything you can't collect. So maybe I make a promise that says, look, 90% of these receivables we believe are fully collectible. And the factor does their work, and they go, yeah, we only collected 82% because the receivables were a lot worse than you said. So we could say, okay, we'll buy back the uncollectible ones then. That's basically recourse. That means the buyer, the factor, has a way to come back at us. Now, there's two possible ways this could be handled. One is this could be treated as a sale. It's just that with a sale, there is going to have to be some recognition of this recourse. Or we could treat it like pledging. Basically, it becomes a borrowing where the receivables act as collateral. Now, you might say, well, is it just a flip of the coin? Does a company just get to decide how to do that? No. There are certain conditions, because you figure if they really want to factor the receivables, they want to be able to recognize it as more of a sale. That would seem to be preferable. So there are conditions that are required to be met in order for a sale to be considered, even if it's with recourse. First, you have to be able to estimate the obligation. So as the transferor or the seller, you have to be able to say, well, I anticipate so much I will end up having to buy back under the recourse terms. You have to be able to reasonably estimate that. In other words, it's like estimating bad debts. Second, the seller, the transferor, says, but I'm relinquishing control. They are your receivables, factor. You can do with them whatever you see fit. And third, I can't be forced to repurchase them. Now, you might look at that and go, wait a minute. If you cannot force a repurchase, then how the heck is it with recourse? Well, usually it's because there's an alternative method. So they may say, look, if we have certain receivables that are bad, we will give them back to you. And you are then obligated to replace them with new receivables. As long as those three conditions are met, then it's treated as a sale, just like a without recourse, basically. If not, then it's recognized as a loan instead. All right, there is one last thing. Consider this more of a financially creative thing to do with it, is you could securitize the receivables. In this case, you transfer a bucket of receivables to another entity. Could be to a trust, could be to a subsidiary. Then that trust, that subsidiary, sells stock, sells a security, and the security is collateralized by the receivable. Effectively, investors in this securitization, they get paid as the receivables are collected. So in effect, you could say, hey, investors, we've got some outstanding receivables. We're going to sell them to you. We're going to securitize them, effectively collateralize them, at 50 cents on the dollar. So you as an investor would say, so if I think that more than 50% of those are collectible, I would make money because I could pay 50 cents and effectively my security will be worth more than that. More like most securities, it could go the other way. But that's securitization. It's another way to leverage the value of those assets for financial benefit. So now you have an answer to what else could I do with those receivables other than just collect them or write them off. All right, we'll see you on the next one. Thanks.